making the right choice. My name is Fern and I am the Business Development and Marketing Manager at Langricks Accountancy. Today, we're going to be doing a webinar looking at limited company versus sole trader. I've actually run my own companies before, and I've run a limited and been a sole trader. And I know that when you're setting up, it can be very, very hard to decide which way to go. So hopefully after this webinar, you'll have a better understanding which is the best option for you. We're not going to do a Q&A session, as if you do have questions, they're probably going to be very personal to your circumstances and situation, as Billy will go through as we go through the webinar. So we will send out our contact details at the end, and if you do have any questions, you can direct them directly to Billy. So if we go forward, just to let you know a little bit about Langricks, we have offices in Wilmslow and in Home Firth. We have a team of experienced accountants, tax advisors, financial business consultants, and we offer a comprehensive range of services, including bookkeeping, accounts preparation, tax compliance and planning, business advisory, and strategic growth. What sets us apart is our commitment to advising clients throughout every stage of their business journey. We work closely with our clients to understand their objectives, providing a proactive advice to help them achieve both their business and personal goals. And I think today, for some of you, this will be the start of your journey. So let me introduce Billy, who is going to go through the webinar with you today. So Billy is a client manager. He joined us in 2024 after changing career from being a footballer. Believe it or not, Billy is actually one of two ex-professional and now semi-footballers in our Wilmslow office, which I think is pretty cool. But Billy today is going to go through the different options of whether you go sole trader or limited. So I will pass you over now to Billy.
Afternoon. So like Fern says, I'm just going to run through some basics on the difference between a limited company setup and a sole trader setup, just to sort of give you the best idea of how you can structure yourself from the beginning to sort of help you as you progress through your journey. So we'll be looking at sole trader versus limited company, how these work together, how you can move from one to the other. We'll be looking at your VAT and MTD obligations, couple of case studies around a sole trader and a limited company, and then we'll just look at some key deadlines for both setups. So there's a few different things and differences between the two setups across those four bullet points you can see on screen there. So in terms of your tax, as a limited company, you'll pay corporation tax on your profits of the company. So you'll pay that at a rate of between 19 and 25% based on your profits for the year. Your corporation tax is payable 9 months and 1 day after your year end, and your CT600, which is your corporation tax return, is due 12 months after your year end, but generally it's submitted at the same time as the accounts. Whereas as a sole trader, you'll pay income tax on the profits of the sole trade. So you'll pay it at your prevailing rate of tax, which depends on your other income. So it could be 20%, could be 40%, could be 45%. Taxes is payable every January and July. So you'll have a payment on account in January and July, and then you'll have your balance in payment in the January as well. So that's just something to be aware of. Your self-assessment tax return, which is how your profits from your sole trade are reported, that's due by the 31st of January every year. There are new Making Tax Digital deadlines to be aware of if you're over certain profit thresholds, which we'll discuss later. There's also your personal risk to consider when you're thinking about which way to go on this one. So with limited companies, your personal liability in general is limited to the share capital. So when you set up a company, you'll probably choose maybe £1 or £100 of share capital. And in general, that is what your personal liability is limited to there. Whereas if you go down a sole trade route, then there is no limit to your personal liability. So the business debts are your debts, and the creditors of the business can come after your personal assets if it comes that far. Directors do have responsibilities as well. So if you trade recklessly, then you can still face consequences for that. But in general, your liability is limited. In partnership, so potentially you're going to set up with a family member or a friend. You could set up a limited company, or you could also go down the partnership route. With partnerships, then it can be slightly worse. So if your partner can't cover their share of the creditors, then you could also be liable for theirs as well. You've got what's called joint and several liability on that. So unless you go down the limited liability partnership route, if you're just a pure partnership, then you do have quite a lot of personal liability there as well. Compliance workload in general is quite a lot more for a limited company. So you've got your annual accounts, which are filed at Companies House and are publicly available. You've got your CT600, which is your corporation tax return. That's also filed generally annually with HMRC. You've got your annual confirmation statement, which again goes on Companies House. There's new digital ID rules for directors and persons with significant control. So you'll have to verify your identity using the gov.uk app to become a director, or if you're already a director, then there are dates in place of when you'll have to do that by. You also have to have a registered office address, which is publicly available. We find a lot of our clients like to use our address because you don't really want your home address online. The directors and persons of significant control are also publicly available online. So if you prefer anonymity, then sole trade might be the route to go down. As I say, accountants do all this, but it does come at a cost. So obviously, if you're only going to be maybe a smaller operation to start with, then I want to keep your accountancy costs down. It might be better to go down sole trade. Obviously, it depends on your personal preference. With the sole trade, the actual compliance workload is a lot less. So other than your annual return for your tax return, there's not an awful lot more to do. As I mentioned before, there is now Making Tax Digital for income tax, which is making sole tradership a bit more onerous in terms of your compliance, because there will be quarterly returns with MTD for income tax. But if you're below those thresholds, then you'll still just do your annual tax return, and it keeps your compliance down to a minimum. And also another thing to note with sole trade is your accounts aren't publicly available online. So again, if you prefer anonymity, then sole trade might be the way to go. And then in terms of credibility, I think in general, limited companies are sort of seen as more credible. And I come across a lot of people who don't even realize that being a sole trader is an option. So there's definitely that cachet that comes with a limited company, but I think a lot of people don't also realize that you can just trade as a sole trader, but still have a business name that isn't just Joe Bloggs doing XYZ. You can have a business name. So that is just something to also be aware of. So in terms of your decision, it's not set in stone at the get-go. Obviously, if you start as a sole trader and you potentially do better than you think, or you have that natural growth plan, and the plan is always to then incorporate, it's fairly straightforward to do. You could start as a sole trader and eventually move across to incorporating as a limited company. People do it all the time. You can go the other way. It's not as common, but it is possible. And then the other option on there is PLC, which probably isn't relevant to too many because you're talking absolutely huge companies that are sort of floated on the stock exchange and their shares are publicly available. So it's probably not too relevant. But obviously, if you do fantastically well, then it is an option potentially in the future. So if we look at a sole trader, it's a very simple setup. There's no sort of initial setup that you need to do from an accounting perspective. The only thing that probably is relevant is to register yourself for self-assessment if you're not already in the self-assessment scheme. And potentially in the future you might be on MTD for income tax, which again would need to be registered for. You'll pay income tax on all profits, like mentioned. So you'll pay at your prevailing tax rate, which again could be 20, 40% or 45%, 20% for a basic rate taxpayer, 40% for a higher rate taxpayer, and 45% for an additional rate taxpayer. Another thing to be aware of as a sole trader is if you are making profits over £100,000, then your personal allowance starts to erode. So for every £2 over your £100,000 of profit, then you're losing £1 of personal allowance. And also you've got to take into account if you do have other income, that's all taken in account with this anyway. So if you're reaching over £125,000 of income, then your personal allowance is gone. So it's something to be aware of. There's also national insurance to pay on sole trade income. So there's class 2, which is treated as paid if you earn profits over 6,845. If you earn less than that, then you can make voluntary contributions. But if you make more than that, then they are treated as paid. You'll also pay what's called class 4 national insurance. So you'll pay that at 6% up to the basic rate band, which is 50,270. And then you'll pay 2% on anything over that. So that is something to also be aware of. This will just be done within your self-assessment tax return as well. And again, as mentioned, there is unlimited liability to the business creditors, so they could come after your personal assets, potentially a house or something like that, if you can't pay. So it is something that you need to be aware of, particularly if you're thinking of taking out a line of finance through the sole trade. They can come after you personally. Limited company. So I think a lot of people can get this confused in their minds. It is a totally separate legal entity. It's not you. You aren't the business. You might think you are because you're running it potentially on your own, but it is really important that you have that separation in your mind. The limited company is not you. You just can't take money out of it willy-nilly. There are going to be tax implications, and there are good ways to structure taking your money out of a limited company. But if you're just taking it, then it can be quite onerous and quite difficult to unpick. So that's a really, really important distinction to make. And a lot of owner managed businesses can get themselves in a bit of trouble with that. And if you end up taking too much, you can end up in a position where you've got an overdrawn director's loan account, which incurs Section 455 tax, which is a really high rate of tax. And it's something that a route you probably don't really want to go down. So I think it's best to sort of make sure you're staying on top of that and have a clear plan of what you need to live off. And then you can speak to your advisor and get that structured in the best way possible to extract it from the limited company, whether that's a mix of salary and dividends or just salary. It's totally up to you, but obviously it depends on your other personal income. If you've got other personal income potentially from dividends that you're getting from other companies that you're invested in, or maybe some rental income. So it's really important that you seek that individual advice to get the best advice for you. As I mentioned before, corporation tax is payable 9 months and 1 day after the year end, and it's payable between 19 and 25%. So if you have profits in the limited company of £50,000 or under, you'll pay 19%. Over 250,000 of profit, you'll pay 25%. And then anything in the middle, between 50 and 250, you'll pay a blended rate of between 19 and 25%. So it's important that you know the distinction on that one. Dividends, as mentioned, you can take them, but they are taxable on you personally, and they aren't actually a corporation tax deduction, so you won't get a deduction for those when calculating your corporation tax, but it can still be quite an efficient way to take money out of the business, particularly in the basic rate. Director's salary, that is a tax deductible expense for business, and that will just be taxed on you personally through your pay as you earn scheme. So this is often what we see directors doing. It is a really good way of extracting money from the business. Your first set of accounts will be 18 months from the incorporation. So if you incorporated now, your first year end would be January 2027, and then your first accounts would be due 18 months from now. And another important point to note is if you are extracting dividends from a limited company, you will still need a personal tax return because those aren't taxable through the pay-as-you-earn system. So that's how they get caught in the personal tax system. So there's a few different types of limited company. I think by far and away the most common is limited by shares, and most people watching this will be limited by shares. So it's sort of self-explanatory, but your personal liability is limited to your shares. And again, it can be between £1 and £100 of share capital, more if you want. But that is the most common setup that we see. There's also limited by guarantee, which there's no share capital, but there must be one guarantor who guarantees a certain amount at the incorporation. These are usually used in not-for-profits, potentially a charity, or if you are running a property management business for maybe a block of flats, where everyone's paying into the sinking fund, these quite often are limited by guarantee. And then LLP, which I briefly mentioned before, it's a limited liability partnership, which it's in the name. The partners are limited to the amount of capital that they've introduced to the partnership. So if you want to go down the partnership road, then an LLP might be best, but it is something to be aware of that LLP accounts are still filed at Companies House. VAT registration. So this is the same for both setups. So whether you're a sole trader or you're a limited company, then you get caught by the same VAT rules. So VAT registration is mandatory over £90,000 of total taxable turnover. So that's got to be continually assessed. It's on a 12-month rolling basis. So it's something that if you know you're close to that threshold, you should be monitoring it regularly just to make sure that you haven't gone over. So it's in the preceding 12 months from today's date. If you've made over 90,000 of total taxable turnover, then you need to register. Or if in the next 30 days you expect to go over the 90,000, then you should be registering as well. You can voluntarily register, and some people do, but you would probably only do this for a few reasons. One would be if you're in a refund position. So potentially when you're starting out, you might have a lot of initial outlay, which you can claim VAT back on, and you want to get that money back. So that would be a reason. Or if you were making zero rated supplies, could be another reason. So it's there. If you were in that situation, then you may register voluntarily. There is a credibility thing where a lot of people see a VAT registered business as a credible business. You can issue a VAT invoice with a VAT number, and it can give you that reputable air of a business. Or thirdly, if you really ambitious and you think, yeah, we can definitely get over that VAT threshold in the future, it's our plan and we really want to get there, then you might do it from the start. You might voluntarily register just because you don't want to get 6-9 months down the line and then have to put your prices up to your customers, or you take that 20% hit in your business because you've now got to charge VAT. So if you're in that position and you're setting up on day one now and you're going, right, this is going to be a really successful business and we're going to get over that VAT threshold, then maybe consider voluntarily registering from the outset. There's different intervals that you can be on. So you can be quarterly VAT, you can be monthly VAT, you could do the annual accounting scheme. So by far and away, the most common is quarterly. So that is what most people will go down. You can go on monthly. Again, you'd probably only go on monthly if you were expecting refunds and you wanted that cash flow to come through quite regularly. With monthly, obviously, if you're going to get your accountant to do it, then it's probably going to be more in terms of fees, and there's also more admin on your end if you're doing it monthly. And potentially you could do the annual accounting scheme, which again is one submission. It keeps your admin and your compliance to a minimum. You can be on that up to 1.35 million of total taxable turnover. So in the initial start of your business, you might consider doing the annual accounting scheme just to sort of keep that compliance to a minimum. So VAT and MTD timeline. As explained, you must continue to monitor your turnover for VAT so you know when you must register. MTD for VAT's actually been in place for a few years now, and it's been a successful rollout, as mostly. And it's essentially just meaning that digital records must now be kept by every VAT registered business, whether that be on an MTD compliant software that you can submit directly to HMRC, or whether you're doing it through a spreadsheet and then using a bridging software to submit your VAT returns. So that's already been in place for a few years now, and like I say, has been successful. MTD for income tax is now coming in, and it's on the same basis really. It's all about digital record keeping, and it's not necessarily about paying more tax. It's just about getting more accurate records sent to HMRC more regularly. In terms of VAT, if you're registered for VAT, you must charge VAT on all of your taxable supplies, and send a VAT invoice. You can recover VAT on all your costs that have had VAT charged on them. So not all supplies are within the scope of VAT. So if you're buying supplies that aren't within the scope of VAT, then you can't claim VAT. And equally, if you're buying off a non-registered supplier, you can't claim VAT. You can only claim if it's actually been charged, and you would need a VAT invoice to be able to claim it. As mentioned, you can use MTD compliant software such as Xero, QuickBooks, etc. Or like I say, you can do it on a spreadsheet. We'll look at some of the softwares that you can use a bit later on as well. So MTD, like I say, it's been mandatory for VAT for a few years now, and it's all about digital records being required. As the slide says there, income tax MTD is coming, and it's coming very, very soon. So the first deadline is the 7th of August for everyone that's mandated to be in MTD for income tax in 25-26. So the first one will be on the 7th of August. It's reporting from the 6th of April to the 5th of July. So it's just something to be aware of if you are mandated to be within it. So when I say mandated to be within it, there are thresholds that the revenue are using to see who's going to be in MTD for income tax on what years, and it's going to be a sliding scale downwards over the next few years. So all sole traders that have income over 50,000 in tax year 24-25, they will automatically be mandated for MTD for income tax for 26-27. So if you're thinking of starting a business now, then you won't have had that level of sole trade income in 24-25, and therefore you don't need to worry about MTD for income tax in 26-27. But for 27-28, the threshold drops to £30,000 of turnover, and that's based on 26-27. So potentially you could start your business now. If you earn over £30,000 in this tax year, then you're going to be mandated for MTD for income tax for 27-28. And then 28-29, the threshold drops again. It's going to be £20,000 of turnover. And again, that'll be based on the 26-27 year. So they're always looking a year behind at your income to see whether you'll be mandated for MTD for income tax for the following tax year. So again, it's just something that you should be aware of. If you go down the sole trade route, you do need to keep an eye on that turnover for the next tax year to see if you need to be in MTD for income tax. And that will then bring you into the system of quarterly submissions. Limited companies are unaffected by MTD for income tax because it is just for income tax, which is sole traders only. So managing your accounts, you can do it numerous different ways. With MTD, you do have to have an MTD compliant software. So there's Xero, QuickBooks, Free Agent, Sage, which isn't mentioned on there. There's loads of different options that you can use. And they definitely help reduce stress for a business owner, and it improves your visibility of how your business is performing. So you can be on those softwares as a sole trader, as a limited company, there's no difference. It's really important to have that visibility. If you use it effectively, it can give you great insight into your business performance and take stress away from big business decisions. Might help you forecast out your cash flow to see if you can buy a new piece of plant, for example. It can be really helpful. But that is all dependent on making sure that the software is up to date. Having the software isn't, going to answer all your questions. It's got to be kept up to date regularly and accurately. So that's what you can do that yourself, or you could potentially get ourselves or another advisor to do your bookkeeping for you, so that your data is correct and you can use it with comfort to know that you're making the right decision. Another thing worth mentioning is a lot of these softwares have the ability to invoice directly from the software, and it will then go straight into your accounting entry as well. So you can use it to invoice your client. It'll go straight to them via email. And then it will also go into your accounting system as well. So it's, two birds, one stone, really. And obviously, a big part of being a business owner is chasing in those debts. So these softwares can do that for you as well. If you set a due date on the invoice, then it will automatically chase that invoice when overdue. So it can take a real stress off your shoulders as well in terms of having to chase in those debts. Another really good thing is connecting your bank account to these softwares. So your bank will automatically feed transactions into these softwares, and then they just need to be reconciled accurately. So it really does make it quite easy to get all that data in one place. One thing worth mentioning is the softwares, they regularly run good deals, and Xero actually has one on at the minute until the 30th of January. It's a really, I think it's like 90% off at the minute. Like I say, they all run them at different points. So it's definitely worth it if you're thinking, well, I'm going to start this and I want to get my software set up accurately from the start, then have a look at what deals are on now. If there aren't any deals on at that time, then we get a discount on Xero. So if you get your license through us, then we can pass on that discount to you. But again, like I say, that there's loads of different options you can have, and it's just about picking the right one for you, really. So we're going to have a bit of a look at a case study now, with a sole trader making £60,000 of profit. So as we've mentioned, it's really simple admin. You're only going to have to do your annual return and put it on your tax return, report that income. So really simple from that point of view. You probably aren't going to be VAT registered at that level. So that's another weight off the shoulders. And you probably at that level would be looking to review as your profits grow. So at £60,000 of income, it's probably marginal as to which comes out on top, sole trader or limited company from a tax point of view. So you'd probably be sitting on the fence going, well, if I grow, I might then incorporate. If I stay around this level of income, I might not. So it's definitely something to keep an eye on. Like I say, the calculations are very close. So it might make sense at that level, 60 grand of profit, to maybe stay as a sole trader, just so you haven't got that extra compliance that's needed for a limited company. So that's something to be aware of. What we'll see on the next case study is limited companies, you can control the extraction of the money from the company on you personally, whereas a sole trader, all of that £60,000 will be taxable on the sole trader in that tax year. So the reason we say to monitor as you grow is potentially, let's say in 25, 26, you have £60,000 of profit, and you're sat there thinking, well, I might grow really large in the next year and go to maybe £120,000 of profit. Then you should probably be thinking, right, well, I think I might need to get a limited company here, because otherwise that whole £120,000 of profit you make would be taxable on you in that tax year as a sole trader. Whereas with a limited company, you've got more options to maybe plan that extraction of money from the business more proficiently. So that kind of brings us into the next case study. A limited company making £120,000 of profit. Again, you'd be VAT registered, and there's different things to consider here. So it would definitely make sense, as I say, at that level of it profit to be a limited company. It just allows for more tax planning and flexibility. So like I say, as a sole trader, all of that goes on your self-assessment tax return. And with this amount of income, you would lose the vast majority of your personal allowance. So you'd be paying quite a high marginal rate of tax, over 100 grand. So it really would, be a big tax bill for you personally. Whereas as a limited company, you're going to pay corporation tax on that £120,000 of profit. It would be at the marginal rate between 19 and 25. Done a bit of a calculation, and it would be roughly around £28,000, which would leave you with £92,000 of distributable reserves, which in a limited company is essentially your profits over time. So your accounting profit that you've made since the beginning of the business to where you are to date. And you can then take dividends out of those distributable reserves. You can't take dividends where there are no distributable reserves. So your company has to be making a profit to take a dividend. So this is where it really comes into its own to be a limited company, because you'd only pay income tax on the amount of money that you extract. So you've got £92,000 of distributable reserves, but there's no reason why you have to then extract all of that money from the business. You can leave some of it in the business for reinvestment or purchases of maybe some capital items. So it's really up to you. If you only needed to take £40,000 or £50,000 of that income to live off, then you would be in a much better position from a personal tax point of view, because you're keeping yourself below those thresholds where tax can get quite onerous. Like I say, Dividends then would go on your personal tax return, whereas your salary would be done through pay as you earn. So it's just something to be aware of, that even though you're not a sole trader, if you are going to take dividends from your limited company, then you do need to be registered for self-assessment and making self-assessment tax returns, but you wouldn't be in the scope of MTD for income tax for that. So some key UK deadlines. Self-assessment tax return is the 31st of January every year. So that is for submission of your personal tax return and payment. So that is a really important date to be aware of. Your VAT deadlines, they're going to be different for everyone. So with VAT, you can choose what intervals you want to be on, monthly, quarterly, or annually. And you can also, if you are quarterly, you can choose different quarter ends. So any month you can choose, well, I want to be a January, April quarter, or a February, May, or a March, June. It's totally up to you. So with those deadlines, the payment and submission of the VAT return has to be done a month and 7 days after the end of the VAT quarter. CT600, which is your corporation tax return, and your accounts at Companies House. So your accounts at Companies House as a limited company have to be filed 9 months and a day after the year end. The payment of your corporation tax return is 9 months and a day, and you've got 12 months to submit your corporation tax return, although they're generally done side by side. And then your MTD for income tax quarterly deadlines, they're going to be the same for everyone that's mandated into MTD for income tax. So the 7th of August, 7th of November, 7th of February, and the 7th of May for everybody that's enrolled in that. So they are going to be the same for everybody. So there's a few bits here that we haven't covered. IR35 is one, and that is a big area if you're a subcontractor. So this is to sort of stop personal service companies. So if you are a subcontractor and you work generally for one main contractor, then you should really be considering IR35 and getting some advice around what your obligations are in terms of that. So that's a really important one, and you don't want to get caught by that. Detailed tax calculation. So as I've mentioned a few times, that everyone's situation is different. Everyone has different levels of income. So we haven't gone into detailed calculations here. And if you do want some, then it's best to get in touch with ourselves or a different advisor, as it's important, because like I say, everyone's situation is different, and those detailed calculations will really help you to make the best decision for you. And then there's also different sectors have different VAT rules. So there are some sectors where the VAT can be quite complex, and the construction industry is one, for example. There's VAT and there's CIS. So if you are in a sector such as construction, it's probably best to get that advice early on so that you know what your obligations are. So some key takeaways from what we've done. So structure, there's two main ways you can go down. You can go down sole trade or limited company. Like I say, it's not set in stone, but it is good to get the right setup from the start, so that you know where you're going. VAT, it's the same for everyone. If you're getting close to that threshold, you need to monitor it regularly. And then if you are a sole trader and you're going to be an MTD for income tax, it would make sense to have your quarters aligned for VAT and MTD for income tax, so that the submission can be done side by side. In terms of software, they're really good. Get them going from the start and learn how to use them and use them properly and effectively. They can be a really, really powerful tool for a business owner. So it's definitely something that we would recommend. And like I say, you can review it regularly. So if you start off as a sole trader and you start to grow, then maybe get some advice around incorporating. It's something that you should keep on top of. And as it says on the slide there, get your advice early, learn your obligations, know what you need to do, and it'll make you more successful and a better business owner. And with that, I'll pass you back on to Fern. Fern, thanks for joining.
Thanks so much, Billy. Well, thank you everyone for watching, and hopefully that has helped you make more of an informative decision. Like I said at the beginning, if you've got any more questions, please contact us directly and we'd be more than happy to help. Thank you very much. Bye.